Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, March 25th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, are consensus earnings estimates too high? Our answers are, President Donald Trump continues to sow confusion over trade policy, pledging auto tariffs in the coming days while signaling exemptions from next week's reciprocal duties. It remains to be seen whether such exemptions will be the result of negotiated lower trade barriers or merely exemptions for whiny executives. After all, the squeaky wheel usually gets the grease. Trump also floated secondary tariffs on countries buying Venezuelan oil, an escalation in economic warfare meant to strangle Caracas' global oil trade. The proposed 25% tariffs would hit countries trading with the U.S. if they import Venezuelan oil and gas, even indirectly, despite existing sanctions already choking the country's economy. The new tariffs on Venezuelan oil represent an additional blow to the 20 percentage point increase in tariffs on Chinese goods already in effect and would deepen the economic Cold War between the U.S. and China based on China's dominance of the black market for Venezuelan crude oil. Elsewhere, we continue to sound the alarm bell regarding the delta between our medium-term U.S. growth outlook and the consensus growth outlook. Market risk is asymmetrically skewed to the downside if analysts' expectations for a linear acceleration in S&P 500 sales growth through the first quarter of 2026 and a hockey stick in earnings growth through the third quarter, starting in 3Q 2025, fail to materialize. Wall Street analyst consensus is currently calling for the S&P 500 to return 19% over the next year based on their aggregated bottom-up estimates, which feature 275 buys, 227 holds, and zero sales. Zero sales. Fancy that. Transitioning to our 42 macro dashboard, as always, a wrap up with the question from our community. This one's regarding Q2 thoughts. I thought it was a fantastic question, so let me just unpack it, and let me read it verbatim, and then we'll unpack it. So it says, in the current environment, liquidity is being temporarily supported by the TGA rundown, Besant's continued preference for short-end issuance, and the likely SO large amendments in the next, let's call it 10 weeks. Despite Powell's acknowledgement of slowing growth and increasingly sticky inflation, the market seems to be, pat yourself on the back, I guess I will. The market seems to be latching on to the slower QT as QE on the margin narratives and looking for an excuse to rally on RSI MACD rollovers as it does. Looking ahead to Q2, we're expecting April's QRA quarterly refunding announcement to stay short. Fed watch is pricing the highest probability for a June rate cut, and QT, excluding MBS, will likely end by June, aligning with the depletion of the TGA, all giving perma-bulls confirming headlines for fuel. My apologies there. Given this setup, we are more likely to see a crab through Q2 as bulls and bears fight for momentum with little directional moves, or does this set the stage for a headline-driven melt-up into June that collapses sharply once liquidity support fades and the reality of an inflation regime and looming refis reassert themselves? I think this is the question of the year for now. I mean, obviously, this is very consistent with what we've been discussing in our research for the past several months, and I think it's all kind of coming to a head here in late Q1. So let me start with the first kind of part of the question with respect to the liquidity. Very clearly, this is something that we've been all over in our research for the past couple of quarters, is the fact that we're going to have a lot of TGA spin down in the first half of the year. We were very early in catching a wind of the Trump administration's decision to, likely pending decision to eventually lower or scrap altogether the supplementary leverage ratio, which will free up, on some estimates, upwards of hundreds of billions of dollars of Treasury issuance, maybe $200 to $400 billion. This is about kind of where I've seen most estimates. So that's obviously quite positive for markets and is bullish. Obviously, pulling forward Fed rate cuts is potentially bullish as well. But again, I'm not so sure that the timing of rate cuts is something that the market really cares about. What the market really cares about is whether or not we need rate cuts and how far is the Fed behind the curve, in my opinion. And so getting into the kind of the question part of this, are we more likely to see a crab through Q2 as bulls and bears fight for momentum with lasting little directional moves, or to set the stage for a headline-driven melt-up into June that collapses sharply once liquidity support fades and the reality of an inflation regime and looming refis reassert themselves? I'll be the first person to say I don't know the answer to that question. I said it last week. I want to say on Wednesday of our macro minute last Wednesday, I said, we believe, our core fundamental belief is that we're probably early innings in a bear market, a very cyclical bear market. We ultimately think the dip will be bought and will return to a cyclical bull market relatively soon. And so and going back to what we said last Wednesday, I said we're likely to see, some pretty aggressive down moves followed by some pretty aggressive up moves. Maybe you go down 10, followed by up 8, 9, 10, down 10, 12, followed by up 8, 9, 10, down 10, 12. And so I'm not so sure if that's what this client means by a crab, but that's certainly, in my opinion, what we continue to expect. I mean, we've been talking about this for 3 quarters now. The distribution of probable economic outcomes is as wide as I've ever seen in my career. There's a tremendous amount of right tail risk, not the least of which are all the liquidity positive things that the client lists in this question. There's also a tremendous amount of left tail risk, not the least of which is the potential kitchen sinking of the economy that's borne out by fiscal retrenchment from Doge, tightening the border, and the significant collapse in labor supply that we're likely to see, that we're already seeing, in our opinion, and followed by, obviously, tariff implementation. And then there's the additional uncertainty surrounding all that, which is also causing consumers and businesses to tap on the brakes with respect to economic activity. So, we're of the view that growth is highly likely to slow much faster than consensus expects over the next at least 2 quarters, perhaps 3 quarters. And if we're right on that view, consensus estimates don't even come close to reflecting that on the GDP or sales or earnings side with respect to S&P 500 type companies. And what it ultimately means is that the Fed is probably much more behind the curve than what current market pricing is pricing in. So that doesn't mean markets can't continue to rally on the TGA spin down and the potential relaxation of the SLR, which is becoming consensus. Is another theme that we created that's becoming consensus. But the reality is we are still in a year where the number one market risk is not even faster than expected slowdown in U.S. growth. The number one market risk is what we've been talking about for 9 months now, which is the potential for a global refinancing air pocket in 2025. There's a significant historic acceleration in the lagged growth rate of total non-financial sector debt globally here in 2025. Not all of it has to be refinanced here in 2025, but a significant chunk of that is going to be refinanced here in 2025 into a much higher interest rate regime than the regime that we saw at the all-time lows in interest rates back in 2020. That is very likely to cause capital allocators. It's essentially a lender's market. Capital allocators are going to take their pick of the litter and say, hey, I'm not going to roll over this debt unless you give me a wider spread, lower valuation, higher interest rates, because there's a bunch of other companies and a bunch of other sovereigns that are trying to line up and refinance as well. And don't forget, we still have a $2 trillion plus budget deficit here in the U.S. that needs to be grossly financed. That requires gross financing as well. So this is a very tricky situation. I said this. I really do think that the width of the distribution of probable economic outcomes is going to create a lot of exacerbated trading in both directions. But we ultimately think the longer term investors, medium term investors, folks who are in the market with this specific, goal to retire on time and comfortably, they're better off being patient and not getting sucked in, at any point in time, shorting the lows or buying the highs of any sell off or of any rally. Just take down cash, remain defensive, and try to ride this period out, because again, it's going to be very difficult to trade. Now, if you're a trader, boy, I can't think of a better situation to trade asset markets. If on one hand you have a tremendous amount of right tail risk that needs to be priced in, on the other side, you have a tremendous amount of left tail risk that hasn't even begun to be priced in yet. And so, in my opinion, I just think that makes it very much a trader's environment. But ultimately, our core fundamental belief is that this is going to be a trader's environment in the context of a market that morphs and materializes into a cyclical bear market. So over the medium term, we are expecting new lows in risk asset prices. And if we're wrong on that view, don't forget, 100% of the things that I talk about with respect to growth, inflation, liquidity, corporate profits, monetary policy, fiscal policy, positioning, all that stuff has no bearing, 0% bearing on the positions that our clients have in their portfolio. The only things that impact that are systematic trend following KISS portfolio construction process that we built for retail investors to help them retire on time and comfortably, or our systematic discretionary risk management overlay, which is takes all those sort of core trend following systems, those institutional grade trend following systems, and we apply that across 70 different factors in terms of the proper trade recommendations that Dr. Mo spits out. So, even though I think the market can crash, if the market doesn't crash, Kiss and Dr. Mo will get more bullish and more constructive over time and raise, our client allocations to participate in what could potentially be a raging bull market, given the size under the area under the curve or the right side of the distribution with respect to the distribution of probable economic outcomes. Again, I'm not expecting that outcome fundamentally. I think that's a low probability event fundamentally, but it could happen. And so we need to be, just aware of the width of the distribution probable outcomes. If you're not doing this kind of research to understand the width of the distribution probable outcomes, then we're definitely doing that for you and for our clients. So definitely come check us out if you are confused at all. And I highly recommend you be, because if you're not confused right now, that just means you have your head buried in the sand. You're not doing enough research, and I don't mean mince words about that. Sorry, I don't mean to be pejorative about that, but it is true. This is a crazy time to be an investor. So I want to make sure everyone is aware that we're doing the research to understand this stuff. And that's why our clients can ask questions that are this thoughtful and this detailed, because they're getting the information from us to piece the puzzle together for themselves. And so we're really proud of that. Really proud. So everyone have a wonderful day. Catch you back here tomorrow. Darius Dell here presenting our macro minute for Tuesday, March 25th. Cheers.